Most people spend their entire lives chasing money without ever stopping to ask what it actually is. Not philosophically, practically. What is the thing you're working for? You wake up, commute, sit through meetings, deal with difficult people, and at the end of 2 weeks, a number appears in your account. You spend it on rent, groceries, subscriptions, gas. It's gone before you even feel it. And yet, almost nobody pauses to ask, what just happened there? Because here's what most people assume. Money is real, tangible, backed by something solid. But when you actually look at how it works, the whole system is stranger than most people are comfortable with. Money is not gold. It hasn't been for a long time. The dollar in your bank account is not redeemable for anything physical. It's a number on a screen. Which raises a question that sounds simple but actually isn't. Why does that number mean anything at all? The honest answer is, because enough people agree that it does. That's not a comfortable answer, but it's the accurate one. Money is, at its core, a shared belief system, a collective agreement about value. A piece of paper has no inherent worth. A number in a database has no weight or texture. What gives it power is the fact that millions of people will accept it in exchange for real things. Food, labor, shelter, time, things that are genuinely scarce and genuinely useful. Money works because trust is built into the system, and that trust has a long, complicated history. For most of human history, people bartered. You had wheat, I had iron, we negotiated. The problem with barter is obvious if you think about it for 30 seconds. What if I want your iron, but you don't need my wheat right now? What if we just can't agree on how much wheat equals how much iron? Trade breaks down constantly, economies stay small, coordination is exhausting. So societies invented a medium, something both of us would accept even if neither of us could eat it. Early on it was shells, salt, livestock, grain, things with some practical use or natural scarcity. Eventually, it became metal, gold and silver, rare, durable, divisible. Gold held its value partly because it couldn't be manufactured. Supply was physically limited. You couldn't print more gold. You had to mine it. That scarcity made it trustworthy. For centuries, paper money was just a receipt. You deposited gold, you got a note that represented it. That note was easier to carry than metal, and as long as the issuer was trustworthy, people used it. This is where governments entered the picture, and where things started to shift. Governments liked paper money. It was convenient, and it gave them something gold never could. Flexibility. The ability to create more when they needed it. In 1971, the US officially ended the gold standard. Dollars were no longer exchangeable for gold at the Fed. From that point forward, money became what economists call fiat currency. Fiat means by decree. The dollar has value because the government says it does, and because you have no choice. You pay your taxes in dollars, your employer pays you in dollars, rent is due in dollars. The system enforces its own demand. You need dollars to function inside the economy. That's not manipulation. That's just how monetary systems stabilize themselves. But it does mean something important. The value of money is not fixed. It's managed. Central banks, like the Federal Reserve, influence how much money exists and what it costs to borrow. When the economy slows, they can lower interest rates. More borrowing happens. More money flows. When inflation rises, they tighten. Borrowing gets expensive. Spending slows down. This is a lever, not a perfect dial. And it has limits. We've seen those limits play out in real time. Inflation in recent years reminded a lot of people that money's purchasing power isn't guaranteed. The $100 you saved last year buys less this year. Not because you did anything wrong, because the value of money itself shifted. That's not abstract. That's your grocery bill. That's your rent renewal letter. That's the gap between your income and your actual cost of living. So if money's value can shift, and it's not backed by anything physical, what actually holds the system together? Two things: trust in institutions, and the fact that everyone else is using the same system. Network effects keep money stable. The dollar works because billions of transactions happen in it every day. That volume creates inertia. Switching away from it isn't a personal decision, it's a coordination problem. This is also why currency crises are so destabilizing. When trust breaks, it breaks fast. Hyperinflation doesn't take decades. In some historical cases, prices doubled every few days. People rushed to spend money the moment they received it, because waiting meant it lost value. That's an extreme case, but it illustrates something worth understanding about what money actually is. It's a store of value, a medium of exchange, and a unit of account. All three functions at once. Store of value means you can earn it today and spend it next month without it rotting. Medium of exchange means both parties accept it, so transactions happen without endless negotiation. Unit of account means prices, contracts, debts, and salaries can all be measured in the same thing. When money fails even one of those three jobs, the economy around it starts to break down. Most people in stable economies take all three for granted, which is fair until something disrupts it. Now here's the part most people genuinely don't know. Where does new money actually come from? The common assumption is that governments print it and distribute it. That's not quite right. Most money in a modern economy is created by commercial banks, through lending. When a bank gives someone a mortgage, it doesn't move existing money from one account to another. It creates new money, digitally, by crediting the borrower's account and recording a matching liability. That new deposit is real money. It circulates. It pays contractors, buys materials, funds other purchases. This sounds strange the first time you hear it, but this is how modern monetary systems actually function. Roughly 90 to 97% of money in most developed economies exists as bank deposits, not physical cash. The notes in your wallet are a small fraction of the total money supply. Most of what we call money is digital entries in banking systems, created through credit, which means debt and money are deeply connected. More lending means more money in circulation. When borrowing slows, in a recession, for example, the money supply can actually contract, less money chasing the same goods. Spending drops, businesses cut, jobs disappear. This is why central banks panic when credit freezes. It's not just confidence, it's the actual supply of money shrinking. The 2008 financial crisis was partly this. Credit locked up. Money stopped flowing. The damage was immediate. Now, here's a misconception worth clearing up. People often think saving is always the financially responsible move. And generally, yes, spending less than you earn matters. That part is real. But money sitting completely idle, losing value to inflation, is also a quiet cost most people underestimate. If inflation runs at 3% annually and your savings earns nothing, you're losing purchasing power every year. Not dramatically, not all at once, just steadily, quietly, in the background of your financial life. That's not an argument to take unnecessary risks. It's just an argument to understand what money actually does over time. Money is a tool, and like any tool, how you use it matters more than simply having it. The person earning a lot and spending everything on monthly obligations isn't building anything. The person earning less but consistently directing some portion toward things that hold or grow in value. That's different math. Not because of motivation or discipline, because of how compound effects work over long periods. Even modest, consistent behavior adds up when time is on your side. The opposite is also true in debt. A credit card balance at 24% APR doesn't need you to make mistakes. It just needs time. The interest compounds. The minimum payment barely touches the principal. The balance barely moves. That's not a personal failing. That's the math of high-interest debt running on its own logic. Understanding what money is, really is, changes how you look at these situations. It's not magic, it's not security, it's not a reward for hard work by itself. It's a medium, a shared agreement, a claim on other people's time, goods, and services. What you do with that claim, how you hold it, move it, or let it erode, that's the part you actually control. So the useful question isn't just how to get more money, it's whether you understand what you're actually working with. Most people don't, and the system doesn't go out of its way to explain it. Ask yourself this: if inflation is quietly reducing the value of what you hold, are you aware of it or just feeling it?